In about 2 weeks, the feds will discuss cutting interest rates. We haven't seen a rate cut in more than 4 years. If this happens, we want to make sure we get our finances ready and, of course, right. Joining me this morning to share money moves we might consider making now is financial advisor Derrick Kinney. Derrick, as always, good morning. Thank you for your time on this holiday.
My pleasure, Zach. Good to be with you.
Do you believe we could see a rate cut in the future, in the near future? And if so, sir, how much?
Yeah, I think the betting markets right now are saying it's almost a 95% chance that on September 17th and 18th, when the Fed meets to review interest rates, they typically wait to the last minute, sort of like a cliffhanger in a movie, and they're likely going to say they're going to cut rates at least a quarter point, possibly more, but a quarter point, Zach, is what's expected. Now, when that happens, and if it happens, what we're likely going to see then is mortgage rates will start to come down over the next couple weeks by about a quarter point. So some of our viewers watching right now that have been on the sideline waiting to buy the house, perhaps the monthly payment is too high. This could be a re-entry point for many people to buy the house and get a better rate.
They're ready. They're saying, put me in, coach, right? Talk to us about the next steps we should take, perhaps they're right now in the weeks leading up to this, to make the most out of it.
Well, from an investment standpoint, here's what I found guiding thousands of clients over the years to financial security. Typically, a couple months before the Fed announces a rate cut is when the market goes up the most. We've actually seen that, Zach, over the past couple months. The market's been very, very strong. But if you're wondering right now, is it too late? No. Talk to your advisor about a strategy called dollar cost averaging, which simply means easing money into the market every month into things like the S&P 500 or the NASDAQ, those big blue chip companies, the big reliable technology companies. All of those can be areas where we see quite a bit of growth. But you've not missed the boat. But keep in mind, the market can be volatile, especially if we were to see the market tip into a recession. That's the number one thing the Fed is trying to avoid for people right now.
Derrick, how should people manage? I want to talk to you about credit cards and or debts. How should people be managing this right now?
Well, bottom line, if you have a high interest rate credit card, that interest rate doesn't change at all. The only people impacted by a rate cut are people that have what's called an adjustable rate credit card, where as interest rates have gone up, the rates have gone up, and now this one may come down. Bottom line is credit card debt is always a four-letter word. That's a bad type of debt. Work to pay that off aggressively, especially as you're about to save for Christmas and get ready for New Year's resolutions, all those things. But also keep in mind, if you're about to buy a car, you're likely going to see very attractive interest rates over the next couple months. And here's why. Because as the end of the year comes, those dealerships want to get last year's models off the lot, the new year on the lot, and they're going to bring that to you with really attractive interest rates. So a good used car, you might find a good deal over the next couple weeks. Yeah,
that's great perspective. Out with the old, in with the new. Talk to me about loans. Folks looking to refinance, it would now be a good time?
Well, it could be. Let's say, for example, one of our viewers has an interest rate of 7.5%. They bought in at the very high, and rates drop down to, say, 6.5 to 6.25. Now you want to talk to your bank or your mortgage broker and say, hey, does this make sense? The bottom line is when you do a refinance, there's often fees and costs built in. So you want to ask, how long will it take for me to break even on any fees I pay to refinance? But Zach, if I were watching right now, here's one of the biggest takeaways from what I'm talking about. If you want to borrow money to launch a business or to expand a business, this is prime, because what the Fed does is when interest rates drop, it makes borrowing more attractive, which stimulates the economy. It's sort of like a Lamborghini stuck in city traffic. With high interest rates, there's cars all around it. You drop the rates, the Lamborghini can go out there and really do what it's made to do.
Great perspective. Great perspective. Hey, I know we mentioned cars. What about houses? We keep showing video of homes, so I want to ask you about the housing market.
Yeah, housing right now, it's very interesting because one of the biggest holdbacks for people is not just interest rates, but can they afford the monthly payment? And the interest rate plays a big part of that. So here's what I predict will likely happen. As we see interest rates drop, the people who've been waiting on the sideline to buy will go in to buy more houses, but they're probably not going to see the prices drop. What that means, Zach, is you're going to be in a competitive environment. So if I'm one of our viewers and I want to buy a house, you want to think about how can you stand out. This is going to sound so simple. Writing a note from you and your spouse, if you're married, to the person you want to buy the house from. Tell your story. Tell how you believe the neighborhood is right for you, why you want to buy their house. It's going to help you connect an emotional bond with that seller, stand out, and possibly at least make you a finalist. But more and more people tell me it helps them get the house of their dreams.
Yeah, it's all about being relatable. Derrick Kinney, as always, thank you very much, sir. We appreciate your time.
My pleasure. Thank you, Zach.
Absolutely.